As we proceed in this next video, I've got to make a quick confession to you. As much as I am a huge financial accounting nerd, and I get irrationally excited about most of the things we cover in this class, if I'm being honest with you, cost flow assumptions are probably one of my least favorite topics. I recognize that they're important, but I often find myself getting bored when I'm picturing the flow of units going in and out of a company, and the initial calculations to help you understand what's going on can get a little tedious. So I want you to realize that it's okay to like some topics more than others, and heck, even some classes more than others. I actually think it's good to consciously take note of what areas in accounting you have a genuine interest in, because this can help inform you as to the career path you want to pursue, and even specific areas where you want to really develop some core expertise. In my case, I just have trouble getting excited about cost flow assumptions. So I'm going to try to make this conceptual review as brief and painless as possible. Cost flow assumptions come into play when companies routinely buy the same type of inventory at different prices over time. And this is where we get those dorky acronyms like FIFO and LIFO. So prices are changing over time for otherwise identical units of inventory. And at the time that some are sold, the company may not know or even care which exact specific units were purchased at which specific costs. But under FIFO, first in, first out, we assume that the units we acquired first are sold first. And with all of these assumptions, it doesn't only impact the cost of goods sold for a given sale. The other side of the coin is that the assumption also impacts the valuation of the units left in ending inventory. In this case, under FIFO, your ending inventory would consist of the units you most recently acquired. And as you know, with LIFO, we're doing the opposite. When we make a sale, we take the cost of units that were most recently acquired. Thus, your ending inventory consists of the earliest acquired units. The average cost flow assumption assumes that inventory costs are a mix, some weighted average of all your goods available for sale. And lastly, when companies separately record the cost of individual items as they're purchased and sold, we refer to that as specific identification. And really, this isn't a cost flow assumption per se, because we are tracking exact costs. And it feels incumbent upon me to illustrate these numerically with an example, just to help us proceed to other concepts. We're taking a contrived company that sells one single product and tracks its costs using a perpetual inventory system, meaning that inventory is updated after each purchase and sale. I'm not going to read through all the numbers in this table, but you can see that we start the month of August with 100 units of inventory. 2 purchases are made, and let's take note that prices are rising over time. And then towards the end of the month, 250 units of inventory were sold. So, as we work out some of the math here, I want you to pay attention to the differences in cost of goods sold and ending inventory using FIFO versus LIFO. Again, taking note that the unit costs of this inventory were increasing with time. The first thing I'm going to do is take the sum of all the costs of beginning inventory and the purchases made during the month, which total $4,800. As a quick review, do you remember which term we would use to describe this number? This is our cost of goods available for sale. Thus, as we're tracking cost of goods sold and ending inventory, we know that they are going to sum to equal this amount, no matter the cost flow assumption being used. How they are divided is what's going to differ. So let's explore this initially using FIFO, first in, first out. Given that we had one sale at the end of the month, our first task is to determine the cost of which specific 250 units were sold. Under FIFO, we assume that the earliest acquired inventory is sold first. So this would include all 100 units of beginning inventory, plus 150 of the units that were purchased on August 10th. If we add the unit cost of those together, we will get cost of goods sold equal to $2,800. Then, subtracting this from our goods available for sale, ending inventory will equal $2,000. And that's pretty simple enough. But What would have changed had we used the LIFO assumption? Again, this starts with identifying the costs of the 250 units that were sold. And under LIFO, we now assume that the most recently purchased goods were sold first. We include all 100 units that were purchased on August 20th, plus 150 of the total purchased on August 10th, which now combine to a larger cost of goods sold, totaling $3,200. And now ending inventory is lower this time, at $1,600. So again, this is the exact same inventory using the exact same underlying data. But based on an accounting choice that is entirely up to the discretion of management, we can have significantly different amounts presented on the income statement and balance sheet. In fact, the cost flow assumption we select for accounting purposes doesn't have to have anything to do with the actual flow of physical inventory. In fact, the cost flow assumption that we select for accounting purposes doesn't have to have anything to do with the actual physical flow of inventory. There are trade-offs to either approach, so for now, I really want you to nail down the logic behind these two ends of the spectrum with how we cost inventory and how they impact the financial statements. And a key consideration here is how prices are changing over time. So I'm going to start with a scenario that I think is most easily committed to memory, and that is during periods where prices are increasing, the LIFO cost flow assumption will give you a greater amount for cost of goods sold and a lower amount for ending inventory relative to other methods. And so the mirror image of that is that FIFO gives a lower cost of goods sold and a higher ending inventory. What I'll re-emphasize here though is this is only during periods where prices of inventory are increasing, although that's probably a more likely outcome, right? Economies tend to experience inflation or rising prices. Frankly, I don't recall the last time we here in America were complaining about some serious bout of deflation. But even if average price indices consistently go up over time, that doesn't mean that that's true for all goods that companies purchase and sell. So it's still worth considering that if prices of relevant goods are decreasing over time, you could expect an opposite pattern in terms of how these cost flow assumptions impact COGS and ending inventory. So, how does a company decide on how to account for its inventory? There are actually a number of reasons, which could include simply following the actual physical flow of goods purchased and sold. And like we said before, this is by no means a requirement, but potentially you just keep things consistent with reality. As we'll continue to explore, tracking inventory costs using LIFO is much more intensive and costly in terms of record keeping. Maybe a company uses an alternative just to avoid the headache of LIFO accounting. As we noted in the previous slide, the method you pick has some pretty impactful financial statement ramifications. So the choice could be informed by whether the company prefers to use a balance sheet versus income statement approach. Sometimes you'll look to your industry peers to see what our industry norms are, but I think that the most interesting impact of the accounting choice is on taxes paid, and it's often the most significant reason why a company would ever use LIFO. And let's be clear about why LIFO tends to be more favorable from a tax perspective. Going back to the baseline scenario, where we assume that prices are increasing over time, then under LIFO, cost of goods sold will be higher. Going back to that baseline scenario, where we assume that prices are increasing over time, then under LIFO, cost of goods sold will be higher, which thus reduces taxable income. So that said, this implication is directly noted in the Internal Revenue Code, which states that a company using LIFO for tax purposes must also use it for its financial statements. And this is referred to as the LIFO conformity rule. So there are totally legitimate reasons why LIFO is an appropriate accounting choice. It's always bothered me a little bit from an intuitive perspective that it tends not to match the actual flow of goods, but a healthy number of companies use it, so it's important to be aware of it and its implications. And lastly, as mentioned earlier, one of the main drawbacks to using LIFO is that it can be very costly to implement in terms of record keeping. This can be particularly challenging when you have very frequent purchases and sales of different types of inventory, and when the prices of the goods are quite volatile. So during lecture, we are going to be exploring alternative methods that help simplify the accounting for inventory under LIFO.